What is the stock market and how does it work? You may have heard that companies on the stock market are called public companies, but they didn't start off as public companies. In fact, most companies in the stock market started off as a private company and then eventually decided to go public. And in order to understand the stock market and how it works, it's helpful to understand why a company goes public in the first place. So let's go through a practical example of why companies typically choose to go public. Say there's an entrepreneur out there with an electric car company idea, and he's going to call that company Tesla. He approaches some homies and asks if they want to start the company with him. The homies agree, and they move on to incorporate their business. Incorporation is the term used for the legal process required to form a corporation. There are a few different types of corporations that can be created, but the most popular one that tech startups choose to use today is the Delaware C Corporation, which is a popular structure used by companies like Apple and Google. A couple of noteworthy benefits to mention is that a C corporation limits the liability of the owners. This means that if the business gets sued for whatever reason, you can only go after that business's assets and not the owners. So there's that legal protection that owners like. The second benefit, and there's many others, but the ones that are relevant for the topic today, is that it allows the owners to create shares, which are units of ownership that they can use to provide to co-founders to start the company or to use to incentivize and recruit employees to leave their comfortable jobs and join this new company. And they can also use these shares to raise capital from outside investors, which we'll get to in just a little bit. So the homies are on board, the company's been incorporated, and there are shares available to be used to raise capital to kickstart operations. In the real world, on average, startups will create 10 to 15 million shares on average, again, to give to the founders, employees, and to raise capital. And this is an important concept to understand. So let's shrink the math a bit and discuss it a bit further. Let's say that instead of 10 to 15 million shares, the company only created 100. 10 shares went to employee 1 and 2. 5 went to employees 3 and 4, which means that there's now 70 shares available to sell to investors. So the company now goes through a process called raising capital or fundraising, and it has 70 outstanding shares. It doesn't want to get rid of all of them at one point in time, but it's ready to basically start to use some of those shares to ask investors to give them cash in exchange for those shares. And eventually one investor bites. They believe in the company, they believe in the product, they believe in the team, they believe in the opportunity, and they think that they can get a return on investment if they were to provide cash to this company so that they can kickstart operations. And what starts here is a negotiation between the entrepreneur and the investor. The entrepreneur is going to want to give as little equity as possible for as much money as possible. Why? Because that math basically determines the valuation of a company. And the entrepreneurs and the owners want the valuation to be high because then it means that their piece of the pie is worth a lot of money. Investors, on the other hand, they might respect that. Maybe they were entrepreneurs themselves in the past, but they're also giving cash and it's a risky investment. And so they want a big piece of the pie. They want a lot of equity for as little money as possible, because then that ensures that their piece of the pie is going to bring a big return on investment down the road. And so there's always a back and forth, and there's a couple of tables here that I think do a good job of illustrating this concept. So in the first column here, we have the amount of equity that is at stake. In the middle column, we have the amount of cash that the investor is willing to give in exchange for this equity. And on the third column here, we have two values. We have pre-money and post-money, and these are essentially different ways to look at a company's valuation. Let's focus on post-money, which means after the money is received. If an investor gives $100,000 in exchange for 10% equity, the post-money valuation of that company is $1 million. Think about it. 10% of $1 million is $100,000, so the math checks out. If we take 15% of $666,000 and change, 15% of that is $100,000, and so on and so forth. 20% of $500,000 is $100,000, and that's how the math works out. One thing to notice is that as the amount of equity increases for the same amount of cash, the company valuation decreases significantly. And again, this means that the shares that the owners have is going to be worth a lot less money. Let's go to another example. In this column here, we have a fixed amount of equity, but the amount of cash that is being given by the investor increases. And you can see here with the post-money valuation that the valuation of the company increases significantly as the amount of cash increases. And so there's a fine balance here, because you don't want your company valuation to be super high because it might disincentivize future investors to invest in your company because they think that piece of that pie is going to be too diluted and that you're overpriced. So there is a balance to be had here, but both parties are incentivized to try to get the biggest bang for their buck. And after some negotiations happen, let's say that an investor finally agrees to give $100,000 in exchange for 10% of that company. And this values the company at $1 million. So now the company has 60 outstanding shares. The company is valued at $1 million. If you divide the $1 million by the amount of shares that were created when the business was incorporated, that gives you a share price of $10,000 per share, again, per unit of ownership. And this table here just basically displays what that ownership looks like in a dollar amount. The employee 1 and 2 had 10 shares each, and that brings their piece of the pie worth $100,000. And this is important because as the company continues to grow and make more sales, the valuation of the company is going to increase, and the piece of the pie that these owners have is going to increase along with it. So let's fast forward 3 years and see how the company is doing today. Let's say that Tesla is crushing it. They're generating $20 million in revenue per year. It's a profitable company. It hasn't had to raise additional capital, which in reality probably isn't the case, but we're just keeping things simple here. And it has a new valuation of $120 million. How did we land on this valuation? It's a function of a bunch of different things. So venture capital firms and investors have different formulas or models and inputs and variables that they use to calculate the company's valuation. And obviously the amount of money that the company has also raised goes into this. But as you can see, the company is also generating $20 million in revenue and is profitable. And so you have to look at what the profit margins are and how much room for growth the company still has. And depending on the company's industry, that company might also get applied a unique multiplier that you can apply on the amount of cash that it's producing. In some industries, there might be a cash multiplier of 2 to 3. In other industries, there might be a cash multiplier of 50. It really depends on the type of company and the industry that it's in. But all that is to say that there's this complex formula that investors use to give their best estimate on what they in the private markets think this company is worth. And that's important for the following reasons that we'll get to in just a few moments. At this point, the company has this new valuation and has 3 options. 1, they can choose to stay private. Things are going great. There's no reason to really rock the boat. But in this situation, the major shareholders or the owners, the 4 employees and that 1 investor in this example, are rich on paper. The company, is now valued at $120 million. So their piece of the pie is huge, but they're rich on paper. And the only way that you can sort of cash in on the amount of shares that you own is to sell those shares to either the owners, if they have the cash to buy them off of you, or to a third party. And there's some risks with selling to a third party because it's a stranger. The other owners don't really know what this third party is going to bring to the table. And so there's a liability with staying private, right? Especially if your shareholders want to cash in on the opportunity and move on to other work or starting other companies. Option 2 is to sell the company. Maybe there is a big competitor that you're making nervous and they want to acquire the company because they don't want you to continue to eat their lunch or eat into their market share. Another example of selling the company could be to a private equity firm. And so this is basically a firm that has a bunch of different cash and buys up companies to continue to operate them and run them, to use the cash to then continue to feed the fund. And it's a way that they sort of invest and get a return on their money. So those are 2 sort of common scenarios that companies could pursue if they decide to sell the company. The third option is to go public. And all this means is that the company, instead of working with private investors, is going to, for the very first time, offer shares to the public, which is a bigger pool of investors. And there's a few different reasons why a company would choose to go public. The first and main reason is that it provides a liquidation event for its major shareholders. These shareholders have made a lot of sacrifices. They've worked really hard. They rode the highest highs and the lowest lows to get the company to where it's at today, generating $20 million in revenue. It's nothing to sneeze at. And they're rich on paper, but they want to cash out those shares and actually have that cash on hand, either just for peace of mind or because they want to deploy it against other opportunities that they are interested in. The other reason for a company to go public is valuation. So right now the company's been dealing with private markets, and the reality is that something is worth really only whatever someone else is willing to pay for it. And the private markets might be too conservative. And the company thinks maybe, hey, we might be able to have a higher valuation than the 120 million if we go to the public market. So that's another reason why they might decide to go public. And the third reason is prestige. It's really seen as sort of like a rite of passage for companies when they finally go public. It's seen like, oh, now this company is truly mature and they've made it into the big league. So that's another reason. But really, it's to be able to provide that liquidation event for its major shareholders and to see if they can get a higher valuation than what they're getting in the private markets. Alrighty, so the company has decided to go public, and what they have to do now is they have to hire an investment bank or a couple of investment banks, depending on how big this initial public offering or the IPO is. And the investment bank does a lot of things for the company in preparation of making them go public, but the main three things that they do is they figure out the number of shares to issue to the public, they figure out the offer price, and they figure out the best time for an IPO. And when they get ready to actually do the IPO, the investment bank basically takes the company public by first going through what's called the primary market. And this is where the company shareholders actually make their money. The investment bank essentially goes on a roadshow to hype up the company to large investors and gets them to buy the shares. And the share in this primary market is offered at a fixed price. And that's where a lot of the public basically buys, it's called the public, but it's the primary market. So it's really just authorized investors, but it's a bigger pool than the private markets that the company has been dealing with in the past. And this is where they cash out. This is where they get basically the money in exchange for their shares, and they have a big payday. What happens then? Then the investors that bought the shares in that primary market sell their shares to other investors who then sell it to other investors, and so on and so forth in what's called the secondary market, aka the stock market as you know it. It's this secondary market that is actively followed by the media and produces daily price changes in stocks. The public company at this point, though, does not see profits or losses from the price changes because they already cashed in that primary market. And so the stock going up or down has no real direct impact on the company's profitability because, again, they already cashed in. But after that primary market, investors can then go and feed and sell, the shares into the secondary market, and that's the stock market as you know it. So when you're trading shares of stock in the stock market, those shares are shares that were bought in the primary market and sold off to the secondary market afterwards. And again, the primary market has a fixed price, and the secondary market has a dynamic price that is influenced by supply and demand. So, in order to understand this, it's really straightforward. All you have to know is that the lower demand that exists for a stock will mean that the price of the stock goes down. And the higher demand there is for a stock will mean that the price of that stock will go up. And there could be a lot of different external and internal reasons for this, such as, the public thinking that a company isn't going to do well. Maybe there's some negative news, like a competitor entering the market, or the CEO getting fired, or passing away, or something like that. And on the other hand, there's positive news that may increase demand for the market, such as launching a new product offering, entering a new market, a competitor going bankrupt, or getting added to a big index like the S&P 500, which is what happened to Tesla. So this is a good example. We're going to go through a couple examples to illustrate the supply and demand concept that drives stock prices in the market. So this is the stock price chart for Tesla. And you can see that the stock price didn't really go anywhere until around 2020. And it's worth noting that this has been adjusted to accommodate the stock split that happened last year, but I think the concept pretty much still holds true. The stock really didn't go anywhere until around 2020. And the reason for this is because people didn't really know if Tesla was going to do well long term. The electric car company or the electric vehicle space really wasn't heating up because gas cars were cheaper. And Tesla was producing the product, but it was a very expensive product and wasn't producing it in big numbers. But that started to change towards 2020, and eventually it got added to what's called the S&P 500 index, which is basically a list of the biggest 500 companies in the United States. So people reacted well to that. People reacted well to the idea that the electric vehicle space is here to stay, and it's going to continue to grow, especially as additional manufacturers started entering the market as well. So people got excited, and the demand for Tesla stock just skyrocketed, and that can be seen here through this stock price chart. Another example is CVS Health. You can see that CVS Health was growing, pretty steadily. It had some dips. It had a good run. And then in around 2015, it's been steadily declining ever since then. And the reason for this is because Amazon launched same-day delivery in 2015. And a lot of people in the public, a lot of public investors, saw that as a threat to CVS's revenue model. CVS's revenue model, yes, they have the pharmacy side, but they also depend heavily on the retail side, right? That's why the pharmacy is all the way in the back, because they don't make that much money through the pharmacy, and they want you to go through all of the different retail items to buy something from them because they make money from that. But if Amazon allows now same-day delivery, they give you basically time back, and there's a convenience factor to where someone doesn't have to stop by CVS on their way home from work. They can just order it while they have 5 minutes in between, work or whatever, and they can have that item waiting for them at their home. And so investors reacted negatively towards that, and that's what caused the stock price to go down. And there were other external factors, but that's just one of them, and the stock market really hasn't been able to recover ever since. And so these are a couple examples of, public sentiment and public outlook based on external factors that will cause a stock price to go up or down. Alrighty, summary time. What have we learned? We've talked about private companies going public and reasons why they do it. It's not the only option they have. They can choose to stay private. They can choose to sell to a competitor or be acquired, or they can go public. Going public is certainly an option, and the reason why they do it is because they want to cash out on the shares that they own. We've talked about the stock market being the secondary market when a company is going public. And we've talked about a stock's price being determined by supply and demand. And supply and demand is basically determined by external and internal factors that influence public sentiment. So really the only thing left to talk about is how does one actually buy a stock? And I'm not going to speculate on what stocks you should buy in this video. I'm just going to keep it very transactional and practical. And actually participating in the stock market is a lot easier than you think. All you have to do is basically open up a brokerage account, deposit some cash in that brokerage account. These are examples of some popular brokerage accounts. I've personally used Charles Schwab for the last 8 or 9 years and really like them. This isn't sponsored or anything, but do your research. Most of these brokerage accounts pretty much offer the same thing. The only difference is that Charles Schwab's user interface is a bit dated and more kind of complicated to use, but once you get used to it, it's really not that bad. And these brokerages basically connect you with other buyers and sellers. And so if you're looking to buy a stock, this person probably is looking to sell. The brokerage basically facilitates that transaction to happen. Broker means to facilitate. And so whether or not you want to buy or sell a stock, the brokerage will help facilitate and find that buyer or seller depending on what you're trying to do. And one thing to mention before wrapping up is that there are 2 ways to buy a stock. You can either buy the stock entirely, or if the stock is too expensive, maybe it's outside of your budget, but you still want to own it, you can buy a fractional share of that stock. And most brokerages allow you to do that these days. If you can only afford 25% of Tesla, for example, at the time of this recording, which is around $800, then most brokerages allow you to say, I only want to buy 1/4 of this Tesla share. And that is helpful. It's something new. It wasn't always the case, but it's an easier way. It's a good way for basically retail investors to be able to own a stock that they might not be able to afford outright. Another good example is Amazon, which is around, definitely over like $3,300, I think, at the time of this recording. Maybe you don't have $3,300 ready to invest in that single stock, but you still want to own Amazon. And it's important to note that this doesn't change your ownership. You still basically own that representation of the total piece of the pie for that company. So it doesn't change or impact in any way. It's just instead of owning the full stock, you own that fraction of it. All right, so that's pretty much it. That wraps up this high-level overview about the stock market, how companies end up on the stock market, and then how the stock market works from there. So if you have any comments, questions, feel free to leave them in the section below, and I'll see you guys on the next one.